You are about to start a business. You have a product, a marketing strategy, and a target audience. You have spent months researching your industry, analyzing your competitors, and designing your brand identity. However, none of that matters if you do not understand the fundamental economic architecture that dictates whether a commercial entity survives or perishes. The market does not care about your passion, your work ethic, or your ultimate vision. The market is a mechanical system that operates exclusively on the logic of mathematics and liquidity. Most new business owners fail within the first 2 years. They do not fail because they lack customers, and they do not fail because they lack good ideas. They fail because they possess a fundamental misunderstanding of how money actually moves through a commercial system. They confuse paper metrics with physical survival. They look at their bank accounts and make decisions based on assumptions rather than objective financial reality. If you want to build a sustainable business, you must discard every emotional attachment you have to money and replace it with clinical, operational discipline. You must understand that business finance is not about complicated spreadsheets or abstract accounting theories. It is simply the story of money moving into your system, money moving out of your system, and the critical time gap between those two events. This is the masterclass in the economic knowledge you must possess before you register your company. We will dismantle the illusions of business finance, starting with the most dangerous misconception of all. The first and most common trap for any new business owner is the obsession with top-line revenue. Revenue is defined as the total amount of money that your customers pay you in exchange for your products or your services. When you launch your business, your payment processing dashboard will show money arriving. You will see transactions of $100, $500, or $5,000. The immediate psychological reaction is to view that incoming revenue as your personal wealth. That is a fatal economic error. Revenue is not your money. Revenue is simply a temporary deposit that the economic system allows you to hold before you distribute it to your operational liabilities. To understand this, we must examine the most primitive model of commerce, a physical lemonade stand. You spend $10 of your initial capital to purchase raw lemons, refined sugar, paper cups, and ice. You stand outside for 8 hours and sell your entire inventory, collecting a total of $20 from passing customers. That $20 is your gross revenue. It is the total volume of cash that entered your system. However, you have not actually earned $20. To calculate your true economic gain, you must subtract the original $10 you spent on the cost of goods sold. The remaining $10 is your actual profit. In the real world of modern business, this equation becomes far more complex and dangerous. A startup e-commerce company might generate $100,000 in gross revenue in a single month. The owner might celebrate this milestone, believing they have built a highly successful enterprise. But underneath that $100,000 of revenue lies a complex web of costs. The cost of manufacturing the physical goods might be $40,000. The cost of digital advertising to acquire those customers might be $30,000. The monthly costs for warehousing, shipping logistics, software subscriptions, and employee salaries might total $25,000. When you subtract all of these expenses from the initial $100,000, the actual net profit remaining is only $5,000. The business owner moved $100,000 through their system merely to capture $5,000. If the cost of advertising increases by just 5%, or if the cost of raw materials increases due to supply chain disruptions, that $5,000 of profit is instantly vaporized. The business is now operating at a loss, despite generating massive volume. Revenue is a vanity metric. It represents the size of your operation, but it does not represent the health of your operation. High revenue without strict cost control is simply a mechanism for losing money at a faster and larger scale. Before you start your business, you must project your exact profit margins. You must know exactly how much it costs to produce your product, how much it costs to acquire a single customer, and how much it costs to keep your operational lights on. Profit is the only metric that sustains your business. Once you understand that profit is more important than revenue, you will encounter the second major economic hurdle, the difference between accounting profit and liquid cash flow. This is where profitable businesses quietly die. In the world of finance, there are two primary methods of accounting. The first is cash accounting, where you record income only when the physical cash enters your bank account, and you record expenses only when the physical cash leaves your bank account. The second is accrual accounting, where you record income the moment a sale is made, and you record expenses the moment a liability is incurred, regardless of whether the physical money has actually moved. Accrual accounting is excellent for showing the long-term trajectory of your business, but it creates a dangerous illusion of safety for a new entrepreneur. You can look at your profit and loss statement and see a net profit of $20,000 for the month. However, if your customers have not actually paid their invoices yet, that $20,000 exists only on paper. This introduces the concept of the cash conversion cycle. The cash conversion cycle measures the exact number of days it takes for you to invest $1 into your business by purchasing raw materials or paying for labor, and the moment that dollar returns to your bank account through a customer payment. Consider a commercial bakery. The bakery operates efficiently and maintains a 50% gross profit margin. One day, they secure a massive contract to supply baked goods to a regional grocery store chain. The contract is worth $50,000 per month. The bakery owner is ecstatic, knowing this contract will generate $25,000 in profit. However, corporate contracts operate on delayed payment terms. The contract stipulates a payment term of net 60 days. This means the grocery store will pay the $50,000 exactly 60 days after the bakery delivers the final product. From an economic perspective, let us analyze what happens during those 60 days. The bakery must purchase flour, sugar, and packaging materials up front. They must pay their commercial electricity bill every single month. They must process payroll for their bakers and drivers every 2 weeks. The bakery is actively bleeding physical cash every single day to fulfill this massive order. On their accounting ledger, they show a massive profit, but in their actual checking account, the balance is dropping towards zero. If the bakery does not have enough working capital to cover the expenses for those 60 days, they will miss payroll. Their suppliers will cut off their raw materials. Their commercial landlord will issue an eviction notice. The bakery will go completely bankrupt on the 45th day of the cycle, despite holding a highly profitable $50,000 contract. Cash flow is the oxygen of your business. Profit is simply a theory until the cash is collected. Before you start your business, you must map out your expected cash conversion cycle. You must know exactly how many days your cash will be trapped in inventory and accounts receivable before it returns to your control. To master your cash conversion cycle, you must implement rigid control over your accounts receivable. Accounts receivable represents the money that your customers legally owe you for products or services you have already delivered. Many new business owners, particularly in service-based industries or business-to-business models, are terrified of demanding prompt payment. They fear that strict collection policies will offend their clients, damage their brand reputation, or drive customers to their competitors. Consequently, they allow their clients to dictate the payment timeline. They send an invoice with a standard 30-day payment window, but when the client ignores it, they send polite, passive reminders rather than enforcing the terms. This lack of economic discipline will destroy your liquidity. When you allow a client to delay a payment, you are effectively acting as an unregulated bank. You are providing them with a zero-interest, short-term commercial loan. If your business generates $100,000 in credit sales every month, and your standard collection period is 30 days, you have $100,000 floating in the market at any given time. If your lack of collection discipline allows that average payment period to drift from 30 days to 45 days, you have just permanently locked an additional $50,000 of your working capital out in the market. That $50,000 is cash you desperately need to run your daily operations. Because that cash is missing, you are forced to seek external funding. You pull from your emergency savings, you utilize high-interest business credit cards, or you secure an expensive line of credit from a commercial bank. You end up paying 15% annual interest to borrow money simply because you are too afraid to demand the money that your wealthy corporate clients already owe you. Before you launch your business, you must establish non-negotiable credit policies. Define your payment terms clearly on every single contract and invoice. Implement automated follow-up systems that trigger 3 days before an invoice is due, the day an invoice is due, and 3 days after an invoice is past due. Offer early payment discounts, such as a 2% reduction if the invoice is paid within 10 days, to incentivize faster cash velocity. You must treat accounts receivable as a strict operational pipeline, not as a test of customer friendship. While service businesses struggle with accounts receivable, product-based businesses face an equally dangerous economic trap: inventory management. When an entrepreneur secures funding or generates initial sales, there is a strong psychological temptation to buy inventory in bulk. Buying in bulk often lowers the cost per unit, which theoretically increases the profit margin. Furthermore, having a warehouse stacked to the ceiling with physical products provides a false sense of security and business legitimacy. In the discipline of financial management, excess inventory is classified as dead capital. Inventory is nothing more than your liquid cash frozen into a physical form. When you use $100,000 of cash to purchase physical goods, you no longer have $100,000 to pay your rent, fund your marketing campaigns, or cover your payroll. That cash is completely trapped inside cardboard boxes sitting on steel shelves. If your business generates $50,000 in monthly sales and your cost of goods sold is $30,000, holding $150,000 in physical inventory means you are carrying 5 entire months of stock. Unless your customer demand is perfectly predictable and completely immune to market fluctuations, this is an incredibly inefficient use of capital. If consumer trends shift, if a new competitor enters the market with a superior product, or if a global economic downturn reduces consumer spending, those physical products will stop moving. If a product sits in your warehouse for 90 consecutive days without generating a sale, it is no longer an asset. It becomes a financial liability that incurs ongoing storage costs and degrades in value. You will eventually be forced to liquidate that inventory at a massive discount, destroying your profit margins simply to recover a fraction of your trapped cash. To prevent the accumulation of dead capital, you must monitor your inventory turnover ratio. You must identify which specific products generate consistent cash flow and which products sit idle. You must optimize your supply chain to order smaller, more frequent batches of inventory, prioritizing liquid cash reserves over slight reductions in unit costs. Just as you must accelerate the incoming cash from your accounts receivable, you must strategically manage the outgoing cash of your accounts payable. Accounts payable represents the money you owe to your suppliers, vendors, and service providers. A common mistake among inexperienced entrepreneurs is the desire to pay every bill immediately upon receipt. They believe that paying a supplier on the very same day the invoice arrives demonstrates professionalism and financial strength. While this practice builds excellent relationships, it is a poor economic strategy. If your primary supplier provides you with commercial terms of net 30 days, they are legally granting you a 30-day window to hold onto your cash. By paying that invoice on day 1, you are voluntarily surrendering 29 days of liquidity. In commercial finance, the timing of your cash outflows is just as critical as the timing of your inflows. If you purchase $40,000 worth of raw materials every single month, utilizing the full 30-day payment window allows you to keep that $40,000 in your operational bank account for an entire month. That cash can be used to generate more revenue, handle unexpected operational expenses, or simply provide a buffer against late-paying clients. As your business grows and your order volume increases, you should actively negotiate longer payment terms with your key suppliers. Moving from a net 30 agreement to a net 45 or net 60 agreement drastically improves your short-term cash position. However, strategic delay must never cross the line into default. You must never miss an agreed-upon deadline. Damaging your commercial credit rating or destroying the trust of a critical supplier will cause far more operational damage than a temporary cash strain. The goal is not to avoid paying your debts. The goal is to align your payment timing precisely with your overall operating cycle, ensuring that money leaves your system only at the absolute last responsible moment. You now understand the mechanics of revenue, profit, receivables, inventory, and payables. But even if you manage all of these elements perfectly, you will still face the unpredictable chaos of the open market. Economic downturns, supply chain failures, legal disputes, and catastrophic equipment breakdowns are not rare anomalies. They are guaranteed mathematical probabilities. To survive these shocks, you must construct a financial harness. You must build a dedicated cash reserve. This is not money meant for growth, expansion, or marketing. Its sole purpose is to absorb operational shocks and prevent your business from collapsing during a crisis. Consider the economic model of a commercial heating, ventilation, and air conditioning installation company. This company generates $220,000 in monthly revenue. The cost of their physical materials, such as compressors, copper tubing, and refrigerant gas, totals $110,000. This leaves them with a gross profit of $110,000. Their fixed monthly operational expenses, including technician salaries, warehouse rent, commercial vehicle insurance, and fuel, total $64,500. This leaves them with an operating profit of $45,500 before taxes. An undisciplined business owner would view that $45,500 as excess capital available for immediate consumption or aggressive expansion. However, a financially disciplined operator implements a strict allocation framework. Every single month, without exception, this HVAC company automatically transfers exactly 10% of their gross profit, which equals $11,000, into a separate, isolated business savings account labeled as the contingency reserve. Over the course of 6 months, they build a liquid reserve of $66,000. In the 7th month, an unexpected crisis occurs. 2 of their primary service vans suffer simultaneous transmission failures. Furthermore, a major commercial client demands a refund due to a defective batch of ductwork that was improperly installed. The total cost of the vehicle repairs, towing, and the customer refund amounts to $24,000. Because the company rigidly adhered to their cash reserve allocation, this crisis is merely an administrative inconvenience. They transfer $24,000 from their reserve account into their operating account. The vans are repaired immediately. The customer is refunded promptly, protecting the company's brand reputation. The business continues to operate without missing a single beat. If that same company had operated without a cash reserve, that $24,000 shock would have been fatal. They would not have had the cash to fix the vans, meaning their technicians could not drive to job sites, instantly halting all new revenue generation. They would have been forced to take out high-interest, short-term merchant cash advances, incurring massive debt just to survive the week. Before you start your business, you must calculate your average monthly operating expenses. You must then establish a target reserve amount equal to at least 3 to 6 months of those expenses. You build this reserve by systematically allocating a fixed percentage of every single dollar of gross profit you generate. This reserve is the barrier between a manageable, operational problem and total bankruptcy. Strategic knowledge is useless without tactical execution. Managing your business finances is not a task you perform once a month when you hand a shoebox full of receipts to your accountant. It is a daily, mandatory, operational discipline. The first rule of tactical financial management is absolute separation. You must open a dedicated commercial checking account before you accept a single dollar of revenue. You must never, under any circumstances, commingle your personal expenses with your business expenses. Buying a personal coffee with your business debit card destroys the integrity of your financial ledger and makes accurate cash flow tracking impossible. You must implement a daily financial review routine. At the end of every single workday, you must dedicate 15 minutes to reviewing your banking dashboard. You must look at every single transaction that occurred that day. Every dollar that leaves your account must have a clear, justifiable business purpose. You cannot use vague categories like miscellaneous. You must categorize expenses precisely: marketing, software, logistics, inventory, utilities, or payroll. You must establish strict daily expense limits. For example, you decide that your discretionary daily operational spending should not exceed $300 unless it is explicitly pre-approved by you. This prevents the silent, cumulative drain of small, unnecessary purchases from destroying your monthly margins. You must track your subscription software meticulously. Software companies rely on the fact that business owners forget they are paying $20 a month for a tool they stopped using 6 months ago. Review your recurring charges every single week. If a subscription is not directly generating revenue or significantly saving operational time, you must cancel it immediately. Furthermore, you must project your spending before the day begins. Write down the exact expenses you expect to incur that day. At the end of the day, compare your actual spending against your projection. This gap analysis will instantly reveal where your financial control is slipping. If you implement all of these disciplines, your business will grow. Eventually, growth will require more capital than your internal cash flow can provide. You will need to purchase expensive machinery, expand your physical location, or hire a massive team. This requires external funding. Many business owners fail to secure commercial loans because they fundamentally misunderstand how lenders evaluate risk. A bank does not lend you money because you are passionate, and they do not lend you money simply because your revenue is growing. They lend you money based on your proven ability to manage liquidity and generate consistent, predictable profit margins. Before you apply for a business loan, your financial records must be immaculate. Your profit and loss statements, your balance sheets, and your cash flow forecasts must clearly demonstrate that your business generates enough surplus cash to comfortably cover the new monthly loan payments without straining your core operations. You must present a specific, calculated purpose for the capital. Do not tell a bank that you need $100,000 for general growth. You must explain that you need $100,000 to purchase 2 specific pieces of manufacturing equipment, which will increase your production capacity by 30%, thereby generating an additional $40,000 in monthly revenue, which will easily cover the $2,000 monthly loan installment. You must build relationships with commercial lenders long before you actually need their money. Open your commercial accounts with a reputable institution. Maintain high average daily balances. Communicate with your business banker periodically to update them on your growth. When the time comes to request a loan, you will not be a desperate stranger begging for cash. You will be a known, disciplined operator seeking a strategic financial partnership. We have dismantled the mechanics of gross revenue, the critical nature of the cash conversion cycle, the dangers of accounts receivable, the trap of dead inventory, the strategy of accounts payable, the necessity of a cash reserve, the discipline of daily tracking, and the proper acquisition of debt. This is the exact economic framework that dictates survival in the open market. When you sign your incorporation documents and officially launch your company, you are not merely taking on the title of a founder or a chief executive officer. You are stepping into the role of a financial architect. Your primary responsibility is no longer just designing a great product or executing a clever marketing campaign. Your ultimate, overriding responsibility is managing the flow of liquid capital through a highly volatile system. If you ignore these mathematical realities, if you allow your ego to prioritize top-line revenue over bottom-line profit, if you operate without a cash reserve, and if you let your clients dictate your payment terms, the system will systematically crush you. You will work 14 hours a day, 7 days a week, sacrificing your physical health and your personal relationships, only to find yourself drowning in debt, entirely trapped in a financial prison of your own making. But if you internalize these principles, if you track your expenses daily, if you fiercely protect your profit margins, and if you build a fortress of liquid cash reserves, you will create a commercial machine that is virtually indestructible. You will not just survive the inevitable economic storms, you will thrive in them, utilizing your superior liquidity to capture market share while your undisciplined competitors collapse. The market is entirely indifferent to your existence. It will not forgive your ignorance, and it will not reward your mere effort. It only respects mathematics, preparation, and liquidity. You now possess the blueprint. The ledger is open. The numbers are waiting for your command. It is entirely up to you to ensure that the final entry is written in black, not red.